those who don't know me, my name is Cudjoe-Virgil. Our company is called Merlin Acquisitions. We are a Baltimore-based real estate private equity firm. We're primarily focused on multifamily acquisitions. Most of our properties are located in the Baltimore city market. And what we do is essentially we look for value add and opportunistic real estate investments. And we help busy professionals, professional athletes get exposed to diversified real estate assets. So a little bit about our team. My background is in asset management, worked for several asset management firms, and then leveraged that experience and skill set to do my own deals. And we also have resources on our website. One of the top resources that we get a ton of downloads on is this multifamily due diligence checklist, pretty much a soup to nuts due diligence holistic checklist on what to look for when you're evaluating multifamily opportunities. We also have a syndication guide for passive investors as well that our passive investors enjoy as well. And then also here with our invest section is our investor group questionnaire, where if you're interested in passively investing, definitely fill this out and would love to connect with you. So today's topic is understanding commercial real estate loans, right? Debt is your biggest partner typically on real estate deals. We're talking about 75% leverage, 80% leverage, depending on how you're putting debt on the deal. And there are a bunch of different products that are available to put debt on a specific deal. It can be a bank loan, it could be agency financing, a whole bunch of different asset loan structures. But we're going to talk about quite a few things today in hopes of really just getting people exposed to the different products that are out there. So let's start off, right? Because debt is the biggest partner on your real estate deal and also the highest risk. We've seen in the past 12 months or so, 12 months, right? Not 12 months, actually about 9 months. But since March 2022, the Fed has been on a tail, increased rates, faster than any other time in history. And people are really thinking about, where are interest rates heading right now? I would say that nobody really knows. We can only speculate based off of what has happened in the past, right? Past behavior can also be a good opportunity to predict the future. And so historically, the Fed typically, since their first hike in interest rates, typically from then, it's about 18 to 24 months before the first cut. So if we had the first hike in 2022 around March time, that would put us about 18 months late this summer or sometime next year, March, to a point where we get the first cut in interest rates. And obviously there are a lot of things that are going on in the economy right now. It's a lot of uncertainty, but the point is, as a real estate investor, you must be prepared to do deals in any interest rate environment, right? Whether the interest rates are down, up, there are always going to be opportunities. And if you're an active real estate investor, you want to do more and more deals. So structuring debt, right? When I look at structuring debt, typically it has to match the specific deal. And so generally you're going to run into maybe a core deal, a value add deal, or a distressed asset. So when I look at a core deal, obviously it's something that's stabilized, something that maybe does not need a ton of work. It might be an operational play. And a lot of times these assets likely are going to be maybe a long-term hold for someone, right? It's a core deal, top of the market, long-term hold, just sit on it, cash flow. Then you have the value add opportunities. And these opportunities can be a sort of hybrid between maybe a bridge loan or going straight to Fannie and Freddie, right? We're going to talk a little bit more about the Fannie and Freddie situation. But typically in a value add distressed deal, you may go into a bridge debt, a debt product where the deal is probably just, doesn't match the requirements for Fannie and Freddie. And then you might refinance into a Fannie and Freddie deal. Or you might, like I said, just go straight to Freddie, right? Or Fannie Mae. Then you have the distressed assets, right? And those generally do not fall into the requirements for a typical agency debt or maybe just a traditional bank loan, right? You might have to go to maybe a hard money lender or bridge debt to get these financed, fix it up, and once it's stabilized, refinance, cash out, give your investors back their proceeds, and everyone's happy, right? So, I think in today's market, it's really important to figure out how you're going to structure the debt, because for me, I don't want to get into a long-term fixed rate position in today's environment if we say that the next, 6 months from now, maybe, 12 months from now, roughly, we're going to see the first cut in interest rates, right? Because essentially I'll be paying for today's capital tomorrow, right? And so I think we're in this kind of situation where we don't know where things are going to land, but we certainly don't want to get in a situation where we're locked in on a higher interest rate for the long term, let's say next 5 to 10 years, right? Obviously, that has a lot to do with cash flow and the overall proceeds and the cost of debt, but definitely understanding how you're going to structure the debt in today's environment is super, super crucial, because debt is always the biggest killer on real estate deals. So the next thing is just preparing for the net worth and liquidity requirements, right? So one of the things that I started doing before I, did our first deal, let's say maybe 12 months ago. That was longer than that. But one of the things that I did when I was building, my team out was figuring out, how can I find some key principles, right? Building that list of key principles from going to different meetup events, networking events, all of these conferences. I guarantee you can find at least 2 key principals who are just lending their balance sheet, and maybe you just want a piece of the GP, right? Because you have certain net worth and liquidity requirements that require you to be able to qualify for the loan. And sometimes other GPs can come on your deal and be a key principal or a sponsor, right? And essentially, key principal is basically someone who is lending their balance sheet and signing on the loan. Essentially, that's what a key principal is. And this can also be an LP, right? So, one of our investors, on our last couple of deals, invested $100,000, right? And he also had a balance sheet and a net worth that we actually added him to the GP and, qualified for a loan, right? Your limited partners, your passive investors can also be KPs as well. So sometimes there are certain requirements in ownership. So typically it's not more than 20% of ownership of the deal. So sorry, let me say this. So typically, if your LP can be a key principal on the deal, if they don't want to sign on the loan and be a key principal, they can't own more than 20% generally of the entire ownership, or else they're going to have to sign on the loan. That's typically what you're going to see when you're doing a bank loan, or maybe Fannie and Freddie as well. So definitely keep that in mind when you're bringing LPs on GPs as well. So let's talk about key interest rate benchmarks, right? The first one is the federal funds rate, obviously controlled by the Federal Reserve officials. And this is the rate that banks lend reserve balances to each other, to other depository institutions overnight, right? It's essentially the rate that keeps going up. We've been seeing in the last, 9 months or so. And obviously, that's to combat inflation. But a lot of times, conventional loans are moving lockstep with the federal funds rate. Another benchmark is SOFR, right? This is something that a couple of years ago they used to be LIBOR, but now a lot of bridge loans go off SOFR. So this is the broad measure of the cost of borrowing cash overnight collateralized by Treasury securities, right? So the SOFR rate essentially is typically maybe on a floating rate, right? So a floating plus a spread, you'll get to your overall rate on floating debt, maybe a bridge loan, maybe a Fannie floater, or some sort of floating rate tied to it, right? So that's another key interest rate benchmark. The third one is the US Treasury notes, right? And treasuries, as you guys may know, are backed by the full faith and credit of the United States government. And, in a typical, maybe a Freddie Mac, maybe a small balance loan, 10-year note, you might see a 10-year treasury plus a spread. That's going to be your interest rate, right? So these three, I think, are like the key interest rate benchmarks that a lot of commercial real estate investors follow. And obviously there are different ones, maybe like a 5-year treasury or 10-year treasury, that people follow. But generally, these three interest rates are what people follow. All right, so let's talk about commercial property loans, right? We talked about the benchmarks. We talked about, some of the things to pay attention to when you're structuring your debt. But let's talk about commercial property loans, right? So the first one is your typical conventional banker loan, right? Typically, it's a recourse loan. In some very, very small cases, depending on the type of borrower you are, you can maybe negotiate a non-recourse. But typically, when you walk into a bank, you should expect recourse. And they typically require some strong net worth and liquidity requirements. It depends on their credit committee, whoever's going to be doing the final approval. I have seen on smaller multifamily properties that something called a DSCR loan is available. So typically what that is that they're lending on the actual debt service coverage ratio on the property and not necessarily too hard on you as a borrower. When it comes to just evaluating your finances and your tax returns and et cetera. With these DSCR loans, typically you would see them on smaller properties. And the term might vary between 3 to 30 years. So that's great there if you have a property that you want to hold for the long term. Construction of perm loans available. So we have like one of our deals, say 22 unit deal. We have like a construction of perm loan right now. So what we did was we went to a credit union and we got 3 years interest only, which was a construction loan that converted to perm over like a 10-year term, I think, based off of 5-year treasury, and it's going to be repriced every 5 years, right? So the first 3 years is its own term, and then it converts to a perm. 10 years, every 5 years will be repriced over 5-year treasury, plus whatever spread they have in the loan document. So there are construction of perm loans available. Definitely decreases the proceeds that are required to bring to the table. Interest only during the construction phase, definitely available. Typically on bank loans, you have the benchmark rate to be a prime rate, or treasury notes. So your construction loan might be, WSJ prime plus a spread. I mentioned that the 5-year treasury on our deal right now. So benchmarks vary depending on the product. 75% LTV, prime rate plus a spread. Occupancy requirements definitely flexible on a bank loan, and a step down prepayment penalty or none, right? For this deal that I mentioned, 22 unit deal, we don't have any prepayment or exit fee or anything like that. So definitely very good on the flexibility standpoint. Loan assumptions, typically, those have to be negotiated. Those are more prevalent in, Fannie, Freddie, but, these guys are a little bit more cautious. So loan assumptions aren't really, advertised, but definitely with negotiation. No minimum loan amount, 30 to 45-day close, and low cost compared to other loans, right? So conventional loans, pretty good. They have the cons and their pros, but there are other loan opportunities that are available for larger assets that are a little bit more favorable, right? So the next one is an SBA loan, and this is definitely more paperwork intensive, obviously, because it has something to do with the government. But typically with these deals, you see a prime rate plus a spread, 275 plus or minus. I've heard a lot of self-storage operators use this SBA product specifically because they only have to bring like 10% down on a deal like this. And obviously for real estate investors, that's that's gold to our ears, right? If we can bring as little down as possible and be as liquid as possible as real estate investors, I mean, that's a real estate investing dream. So likely going to see some recourse on SBA loans, tend to have low interest rates. Again, this is, a government sponsored kind of loan, typically going to be paperwork intensive, but you get the low interest rates that come with it. So SBA loans available, great on assets like self-storage. All right, let's go to the agency loans, right? And this is typically what you're going to see, multifamily borrowers look at multifamily borrowers place on their properties or refinance into because of a lot of different benefits, right? So typically with the Freddie Mac, say, maybe a Freddie Mac small balance or so, you're going to see a minimum loan amount of $1 million, right? Non-recourse debt. So non-recourse with bad boy carve-outs. A bad boy carve-out is basically saying, hey, if you commit fraud on this property or commit something that's negligent, the lender can come after you personally. So that's all that a bad boy carve-out is. Otherwise, if you do a non-recourse loan and you just wake up tomorrow and say, hey, I don't want to do this deal anymore, you give up the keys, they're not going to come after you personally. Interest only available, depends on what you put on the deal. And they have fixed rate and floating rates available for Freddie Mac loans. On a fixed rate, you might see, a 10-year treasury plus a spread, 100 to 200 basis points. Floating rate, mentioned SOFR plus a spread. Loan assumptions available, which is great. A lot of people, brokers actually today, I get a lot of deals in my inbox advertising for loan assumptions because loans are pretty expensive today. Pricing a new loan just at 75%. I mean, I'm probably looking at 5.5, to 6% today's environment. So loan assumptions look pretty attractive. Terms can be 5 to 7 to 10 years, up to 80%. Rehab budget can be included depending on the type of product. And they have this thing called 90 for 90 requirements. This is really important. Whenever you're putting a property under contract that you plan to do a Fannie and Freddie deal on, is we always put that the owner needs to keep the property 90% occupied for 90 days. And the reason is because if we fall out of this, we're at risk of not being able to close the loan. And so we want to hold the seller's feet to the fire and say, hey, if this property, drops below 90% occupancy for 90 days, in the last 90 days, then, we might have the right to walk away from this deal. Really important clause there. Net worth. So when you're looking at these deals, you have to have a net worth equal to or greater than the loan amount. And then the post-close liquidity has to be at least 10% of the loan amount or 9 months P&I, depending on, the product, right? So as I mentioned, the net worth and the liquidity requirements, as I mentioned earlier, really important to have that lined up going in, because it just saves you a ton of different stress when you're actually applying for the loan and just going through the entire process. You don't want to be scrambling for liquidity or net worth to make the lender feel comfortable. All right, so supplemental loans. So a supplemental loan is basically a subordinate loan. So essentially what a supplemental loan is, you have a property that you could potentially get a second position or a second loan on top of the senior debt, right? And a lot of times what people do is they take this loan out to either do capital improvements on the property, or they take it and they just distribute the cash, to their investors. So you have to be able to qualify. Obviously, your property has to be performing well to qualify for this supplemental loan. But it's definitely available for borrowers if they want to have additional capital to do some of the repairs on the property or just distribute to their investors. And Freddie Mac is actually great for new investors. We're going to talk about Fannie in a sec, but Typically, they have prepayment penalties or step downs. So they might have on a 10-year, they might have a 5-5-4-4-3-3-2-2-1-1, or they might have a 5-4-3-2-1 type of step down. Um, prepayment penalties. They're going to have those on these types of deals. Early rate lock options. So depending on the product, you can rate lock up front. And obviously that's very, very advantageous, especially in this environment where rates have been going up for the past 9 months or so. You want to make sure that you have a rate lock as early as possible, because things can change and you don't want to get caught where you're trying to make your deal work and then you got interest rates against you. So these loan applications can be pretty costly, good faith deposit and loan applications and stuff like that. They can add up pretty quick. So you're going to see a typical, maybe a 45 to 60-day close on a deal like this. All right, so let's talk about Fannie Mae. So in the Fannie Mae's world, they like to see experienced borrowers, and what they maybe qualify from a simple level as an experienced borrower is at least 2 years of ownership experience. And so same thing with Freddie Mac, minimum loan amount of $1 million. They have some early and extended rate lock options depending on the product type. Standard carve outs with non-recourse, interest only, fixed rate, loan assumptions available. They do have a 12-year term, so they have 5, 7, 10, or 12-year terms. Prepayment or yield maintenance. So what yield maintenance is basically you compensating the lender for the interest that they would have received over the whatever term they have for yield maintenance, right? So if you have like maybe say a 7-year term with 6 years yield maintenance, if you decide to sell that loan in year 3, you're going to be compensating the lender for the interest that they did not receive for that period between year 3 and year 6, plus or minus, right? And so definitely, as I mentioned earlier, when it comes to structuring your debt and structuring your debt on your properties, I'm not getting into a deal where I'm putting on long-term yield maintenance if I plan to sell the property in maybe 2 or 3 years, right? It just doesn't make sense. That's not the best business plan or the debt product for this business plan. So you really have to know how to put these debt products, what works for your property, what gives you the best flexible exit options, because you just never know when you're going to get an offer that's super compelling and you want to take the offer, right? So you always want to have that exit flexibility option. Up to 80% loan to values. Rehab budgets can be included depending on the product type. The same 90 for 90 requirements that I mentioned, 90% occupancy in the last 90 days. Loan amounts, post-close liquidity, net worth, all the same things. Supplemental loans available, 40 to 60-day close. Loan applications can be costly. So generally, the Fannie and Freddie agency loans are what multifamily borrowers, syndicators like to get into, because the rates are great. Interest only is always great. Non-recourse is always great. The difference between the Fannie and Freddie, might be the experience or the prepayment penalties, things of that nature. So just want to make sure that you're putting on the right debt again on your property to have a great business plan, right? Have a great exit. All right, so let's go to another one called commercial mortgage-backed securities, CMBS loans, right? Typically, big players, wealthy people get CMBS loans, but also they're also available with or for borrowers that had maybe previous credit issues, that don't really have good credit factors that they can qualify for under Fannie and Freddie Mac or Fannie Mae. Getting tongue-tied here. Bankruptcies, so people who have trouble getting, leverage on their deals for whatever personal issues can go to CMBS, right? So typically offered from commercial banks and investment banks, less strict than Fannie and Freddie loans, 5 to 10-year terms available, non-recourse. It might have a loan amount of $2 million. They have fixed rates, 2 to 3 year lockouts before you can do any sort of exits on these types of deals, this type of debt. Yield maintenance or defeasance, right? So we talked about yield maintenance. Defeasance, what defeasance is basically is that it's a very complicated process by the borrower to substitute the collateral on the debt for something a little bit, something safer, right? Like a treasury bond, et cetera, right? It's a very complicated process, but that's essentially what defeasance is. Okay, so that was a snapshot of CMBS. Again, typically, your average syndicator is probably going to play in the Fannie and Freddie May space. So Fannie and Freddie May. Freddie Mac and Fannie Mae space. And then we also have the bridge loans as well, right? So your syndicator might jump into a bridge loan on a value add play and then refinance into a long-term fixed rate agency debt, right? The trouble in today's environment with the bridge loan is that because rates have risen significantly in the past 9 months, a lot of these bridge lenders are underwriting with higher debt yields. So the debt yield is basically the NOI divided by the loan amount, right? And so the challenge with that is because, if rates continue to go up and up and up, and maybe you took out a bridge loan a year ago, right? And rates have changed, now your debt service coverage ratio is changed, right? And so your bridge lender is going to take that into consideration when sizing your proceeds, because it wants to make sure that it's made whole too, right? When you're trying to exit out of the deal and you're not going to be in any financial pressure. So bridge loans are increasingly expensive in today's environment, specifically with interest rate caps, what we're going to talk about a little bit as well. But generally for a bridge loan, on a case-by-case basis, but generally you're going to see a minimum loan amount of about $5 million. And there are fixed and floating rates options available. We talked about SOFR plus the spread, 325 to 450 basis points. Interest rate caps available. So an interest rate cap is basically, self-explanatory, right? You have this payment that you pay to put a cap on your interest rate, and it's a situation where in today's environment, even over the past 9 months, caps have been very, very expensive just because of the uncertainty of where rates are going to be in the future. And because of the velocity of how the Fed has increased rates, caps have been more and more expensive over the past 9 months or so, right? So definitely have to take that into consideration when you are, because you have to escrow these payments too, right? You have to escrow your payments that are going to be distributed, to the lender if, in a situation like that, right? So interest rate caps, really have to pay attention to it. It's super costly, so definitely talk to your debt person. Recourse and non-recourse available, 2 to 3 year terms plus an extension fee option. So generally you're going to see a 2 to 3 year term on a bridge loan plus an extension option for a fee up to 75% loan to cost. Less strict occupancy requirements. So I mentioned, you can get a distressed property and go to a bridge lender and get a loan, as opposed to going to Fannie Mae and Freddie Mac, because they have the 90 for 90 requirements, but bridge lenders don't typically have those types of occupancy requirements. So because it's a riskier deal, obviously you should expect higher rates. And typically you have maybe a 12-month lockout period, so you can't do anything from a refinance or a sell or something in the first 12 months, then just a 1%, prepayment thereafter. And so, bridge debt, great opportunity to, take a property, obviously for a higher cost, turn it around and then stabilize it refinance into a long-term debt option. Okay, couple more left. So we have the preferred equity and mezzanine financing structure, right? There's a lot of talk about preferred equity in today's environments because a lot of people aren't getting their loan sized to where they thought that they would have maybe 2 years ago. So generally you would see a minimum loan amount of 6 to 8 million, 1 to 3 year term, interest only, lower debt service coverage ratio, obviously because it's it's a situation where this person is going to be in second position, right? You have your senior loan, then you have your mezzanine or preferred equity, and then common equity, which would be like your investors, they would be in that position, right? So you can get up to 90% LTV. Going to have some net worth and liquidity requirements. They're going to be underwriting you as a borrower, making sure that you can pay them as well. And so those options are available in today's environment, for deals that don't get the refinance proceeds that they thought that they would have if interest rates haven't, risen extremely high in the past 9 months or so. Okay, so another one here, I think this is the last one, is a HUD loan. And HUD, obviously, you guys know what HUD is. It's a HUD insured loan that is extremely red tape, but is significantly beneficial if you can go through with it, right? They have a long timeline of like 9 months, typically low interest rates. They work well on affordable properties, and they have long amortization periods, right? Think about the difference between a 30-year amortization versus a 35 to 40-year amortization, right? That's cash flow bonanza. And they have non-recourse available, high leverage, up to 85%, interest only, loans available. As I mentioned, the problem with this is that it's a very, very long process and a lot of red tape that needs to be ironed out to get this deal to close. So, you might see a lot of people, if they have control of the deal for a long period of time, either refinance into a HUD loan because they can wait, or they've negotiated with the seller where they can have this long period of time to get into a HUD loan. So that is pretty much a good synopsis of understanding commercial real estate loans. One of the websites that I typically go to is this website called commercialrealestate.loans. And this is a great website to figure out like what loan product might be available for a specific deal, right? So say, for example, if you were maybe looking at a gas station, for example, right? You would click gas station and they have different loan options that are available that you can potentially just, browse at and look through and figure out, is this a good product for my deal, right? So they have eligible property types here. Like, for example, you could click on the gas station, tells you a little bit about gas stations, tells you a little bit about loan terms that are available out there. And you can talk to them directly about the different loan options that you can get for your gas station. So I thought that it was a pretty cool website that I'd like to share with you guys today. So that pretty much sums up our chat today about understanding commercial real estate loans. Happy to discuss a little bit more about loans out there, maybe something that you guys are working on. But again, thanks you guys for attending this evening. Any questions out there about anything?
Okay, so Yannick, can you explain to us the requirement for, let me find the term that I was trying to understand. Give me one moment.
Sure.
Net worth, yeah, the net worth requirement. Can you explain that to us?
Yeah, so generally, let's say a Freddie Mac loan, right? They're going to require that you have a net worth equal to or greater than the loan amount plus a post-close liquidity. So cash, equities, whatever that's liquid, right? To be 10% of the loan amount or 9 months P&I. And that's how they're going to qualify you for the loan on a net worth and liquidity requirement.
So they're just checking if you have the money, but they don't expect you to, obviously, I mean, because you're taking a loan, they don't expect you to put all that money into the deal. They just want to check
Correct.
that you have some backing. Okay.
Yeah.
And then
correct.
can that be a 401k? Like if you have like $300,000 in your 401k, can you show that as your net worth?
You know what? That's a good question. I'm not 100% sure because I know that 401ks, I think those are like pre-tax dollars. So I'm not 100% sure, but that's a really good question that maybe I could follow up with you directly on. But they generally look for things that are liquid in this 10% post-close liquidity that are ready and available, right? From a liquidity perspective. But that's a good question though. I can follow up with you with that for sure.
Okay, thank you.
All right. Any other questions about some of the financing options? All right.
Okay,
again,
so
guys,
can you share this document with us also, if that's okay with you? Will that be okay? This document?
Yeah, definitely. Yep. I'll get this sent out with the recording as well.
Okay, thank you.
Happy to send this out. So yeah, I think in today's environment, obviously, you really have to make sure that you're understanding your debt because it's a situation where it's very volatile. And like I said, I don't want to get into a deal today where I'm paying today's interest rates if things are going to cut, but again, you don't want to miss out on an opportunity just by sitting on the sidelines, like waiting for rates to jump down. So I think it's about hedging your bets in today's environment, and just at the end of the day, if you can be as flexible as possible to maneuver, I think that's the best route to go to, in the short term at least.
Okay. And one quick question, like, do most of the larger deals, so deals larger than 1 million, do they all generally get into non-recourse loans, or is there larger deals also which the partners try to get on a recourse loan?
So generally, a lot of people like the non-recourse option because, you don't want to cloud up your balance sheet with recourse loans.
Right.
A lender is going to look at all of that stuff too. Typically they don't go into detail about, it depends on the lenders, right? I've seen the smaller banks, or like the community banks ask for a lot of that, like deeper information. So maybe on like a development deal or something, they might ask you a little bit more. They know like you're a developer, they might go into a little bit deeper on your financials to see if like you're over leveraged or you're too heavily tied on a bunch of different recourse loans, because that obviously impacts them and their ability to deem you like credit worthy. But generally, in the perfect world, I always want to get into a non-recourse deal because, as I mentioned, it's not a personal guarantee unless there's a bad boy carve out or some sort of negligence on the property, and it's not going to really cloud up my balance sheet from a recourse perspective. So most syndicators tend to go to the non-recourse route.
Okay.
But in today's environment, though, I have seen a lot of people, and us included, right? We went to the bank loan route, and we took that recourse, because the spread and the rates were so great. So I think it's like the trade-off between your willingness to take the risk on the recourse versus the rate, versus just saying, well, I don't want any recourse at all on these larger deals. I'll just go non-recourse. So it comes down to just an investor taste.
Right. What was the difference? Like the prime rate, is it a prime rate around 4 right now? Is that what it is? And plus
Yeah.
2 points. So maybe 6, you got like around a 5 to 6% rate, right? With the bank, with
Yeah.
the small bank.
So this was before so we did our couple of deals that we did with, that was the construction loan was based off of the prime rate. We did that before rates turned up, rates increased. So that the prime rate around that time was like 3.25. Right now, I think it's 7.5. So things are obviously different in today's environment versus 9 months plus ago, right? So I think it just depends on how you want to put that on the deal, and again, the flexibility to get out, because you might say, well, hey, in today's environment, I'll be willing to, for the deal to be a little low or not crappy, but low returns in the first year, and then you might say, well, I'm hedging my bet that the next, 6 months from now, 9 months, 12 months from now, we'll be in a different environment where we're going to start seeing some cutting. So maybe I'll refinance a year or two from now. So it's just about having that flexibility. I think looking at deals today is the biggest thing, and not necessarily jumping into a floating rate loan, because these caps, and typically what you could do to figure out like where your cap cost would be is something called like Chatham Financial. So if you Google Chatham Financial, they have a cap calculator based off of the loan amount and maybe the strike rate. Maybe it's a 2% cap strike, on the deal, and those are pretty expensive. So I probably wouldn't be getting into to any bridge debt or any floating rate debt unless I was pretty comfortable with paying whatever caps are costing in today's environment. Yeah.
Thank you, Yannick.
Absolutely. Any last questions? All right, guys, I appreciate it. Small group today. Last week was great. Week before was great. We're doing this on a weekly basis, so thanks again for joining in, and I'll see you guys next week.